Okay. Participant application. We have this. It is the top of the hour, gang. So it looks like we've got everybody in the waiting room, or we're getting everybody in the waiting room here in terms of connecting audio. We want to make sure everybody is muted and has their video off for purposes of posterity. And so the easy peasy answer is we got 3 things that we're going to cover today. Yes, I am keeping my background on. I wanted to mix it up a little bit and let you guys just have a different view while I talk this month. So 3 things that we're covering. First is, yes, we're recording it. Yes, it's going to be on YouTube. And that's why we've got everybody muted and with their video off. So that way we can obviously have some privacy for all of our clients and everybody else who wants to join us. Second thing that we're going to go over is very simply what's going on with portfolios, a couple of housekeeping items firm-wise, and then 3, I'm going to do a presentation this month. We'll have probably a couple of presentations through this year, and then we'll be picking back up some of our guest speakers either later in the year or at the beginning of 2022. Wow, it's hard to believe that it's 2022, just around the corner because it is October. So with that, let's dive in now that we know the rules of the road. I did almost forget one thing, which is really important. Let's talk questions real quick. So what do you want to do if you're muted and you've got your microphone off and you want to ask a question? We asked nicely that you send us an email about it if you're a little unsure. And if you want to get heard on this and you're a little bit more comfortable, go ahead and raise your hand and I'll, I myself or Lauren will figure out how to unmute you and let you ask the question. That said, let's dive right in. So we just went over rules of the road. Now let's talk housekeeping. So item 1 on the housekeeping agenda, I mentioned it last month. We are just about complete with all of those required minimum distributions for the year for those folks that it applies to. And so it's my understanding from a meeting we had earlier today that we're a little over 75% of the way on getting all of those out. So pretty much everybody should have heard from us by now, and or money should be in transit in one form or another. We may need some updated forms, so please don't ignore calls from myself, or Lauren, or Charles, or Shelby, or whomever from the office to try and get you caught up and get those funds in your hands. Next item, we're going to talk portfolios real quick. So we have been reviewing some portfolios in terms of what's available, EFTs and mutual funds, stocks, bonds as we come through the end of the year. We did just wrap up the 3rd quarter, so we do have an eye on what's going on, and we have been making a couple little adjustments, little tweaks here and there. Nothing incredibly major, but we are keeping an eye on stuff. And we have been talking to folks. You will notice that we did a little bit of a rebalance a while ago when the market had taken a dip. And I believe that's happened since the last time we spoke. So a few things have gone on, and we've definitely had a few trades in some of those portfolios where we've trimmed a couple of positions in that rebalancing. So that may have applied to you. That's the short answer on some of the housekeeping. The slightly longer answer is that if you're one of our 401k participants, we are going to be making some tweaks to the models. You will see a new holding come in. And if you have questions, reach out to us about it. And we've added in that holding so that way we can more quickly work to get funds into your accounts on the 401k side. So that's the gist of what we've got going on inside of the firm. And how do we want the presentation, which is going to be exciting. So this is actually a topic that got me into the financial services industry to begin with, because I am very analytical in terms of the way I think. I very much so like to put all the mathematical puzzles together, and that's a lot of what financial planning actually is. And so understanding the processes, understanding the way the math works was something that very much intrigued me and something that I enjoyed working through. And through graduate school, various other things. So many of you have heard my story. I came to be in the industry doing planning. And so this is something near and dear to my heart and something we're going to go over. I'm going to share with you all today about the process that we utilize, the process, and how that process kind of goes along with what the folks at the College of Financial Planning say, what a number of the other sort of CE firms, various things say. And so if you're working with me and I've done a financial plan for you and you've always wondered sort of how does William come up with those numbers and what are the originating sources, that is one of the items that you're going to learn about today. The other piece is that if you're not working with us or know somebody who's not and they're curious or about the financial planning or the way it works, feel welcome to show them this video. They'll get a good handle on sort of what we do, how it works, and or they'll, if they're analytically minded, they'll have a good idea of what they need to do for their plan to make sure that everything's functioning properly. And so with that, I'm going to dive in. And everybody should be able to see my screen with what I'm sharing. And so what we've got here kind of on this first page is I've outlined 10 key variables, not in any specific order, but well, alphabetical, with factors that drive financial planning and decision making in terms of the sources. When we're stress testing things, when we're looking at putting together a good financial plan or a good, really financial analysis scenario. And so what we're going to focus on, I'm not going to read these things to you because we can all read, but some of the big drivers that really play into this are, we have this future and present value calculation that we do on a regular basis. And so for those of you that took statistics in school or use statistics on a regular basis, we all know that calculation about present value, number of periods, and the interest rate yielding a future value. And we do that on our fancy financial planning calculators that we have. And so we all know that basically if you manipulate the equation in various ways, you come up with different results and you're able to solve for a number of various items. So that said, things like age and time factor into the equation pretty well, as well as things like interest rates and inflation and the lump sum of capital that you're starting with. So that said, I put together a few slides. Here's where I've taken my sources from. I took my sources from the JP Morgan Guide to Retirement. I also utilize their guide to the markets they come up with on a quarterly basis. Guide to Retirement is done annually. I've also taken some information off of the Social Security website and various sources from Guide to the Markets that I used as a secondary source actually were taken from primary sources like Department of Economics, Ibbotson, Morningstar. So we've worked on some some validated sources. And so I feel pretty confident in the data that's presented here and the way we're using, you're going to utilize these variables. That said, I'm going to dive in. And as I dive in, the key things I want you guys to think about are that we're talking about what goes into stress testing, what goes into building the plans. So we're not talking about specific strategies. So things like required minimum distributions aren't really what we're going to address today. What about Social Security? Well, we're going to address some of the driving factors associated with Social Security because I just referenced that I pulled some data off their website. And then next factor, taxes. Well, taxes kind of play into the equation, but they affect us all, so they're kind of an equilibrium item. So they're not really a variable that comes into financial planning too much because we're usually planning for assets that exist and planning for something in the future. We're not typically planning to say we have 4 buckets tax sensitivity wise, where do we put this money, and answer that question. So we're not focusing too much on taxes today, but we do understand that they do play into the calculus. So that said, item 1. So item 1 here is going to be life expectancy. And I've got a chart up that I got from Guide to Retirements, which illustrates a number of things. And by the way, This is Bureau of Labor Statistics stuff. And pardon me real quick while I move a window so that way I can actually see what I'm presenting to you guys. So we run all of our financial plans out to age 95, soon to be age 100. And many of you, some of you on the call even, have said to me, age 95 seems a really long way out. I don't think that that's really the right number. Well, if you were married, if you are married, see this green column here? 20% chance of making it to age 95. And then it drops all the way down to 4% by the time you get to age 100. That is a big number, folks, a really, really big number. And so if you think about 1 in 5 making it to age 95, the break even below 5% comes out to about age 98 and a half, somewhere in there, just from a statistical range standpoint. So, and by the way, that's if you're 65 today. When I first started in the industry, they were teaching us and telling us, this is College of Financial Planning stuff, that we only needed to run financial plans out to age 90. So in my career, and I'm not that old, folks, I mean, I have been doing this a while though, we've added 10 more years to the planning cycle. Big number. Next, we're going to talk about allocation of investments. I've got this chart along here that tells us how assets have performed in the last 20 years and how various ways that your asset bases, your asset allocations have performed. A standard 60-40 mix, which is pretty common in retirement, 60-40, 50-50. So we're looking at right around a 6% rate of return. Now that's key, because many of you noticed that when we stress test and when I run my plans and my scenarios, when we're in that retirement, that post-65, that drawdown phase, I utilize 5% or slightly lower. And the reason is this gives us a further buffer on your total asset pool from 6.4 to 5.0. Now we expect to have a number bigger than 6.4 as annualized returns in retirement. But the point is that when we move all the way down to 5.0 and 4.9 in terms of rates of return, now we increase the likelihood that we'll have the event of you reaching your desired retirement spending goal. Now, one thing that I will note on this chart that's an interesting outlier, it says that the average investor, now this is based on a long-term study of people that manage their own investments, typically only receive a 2.9% rate of return annually. Maybe they're buying at the wrong times, maybe they're buying the wrong things, not entirely sure. But what it tells us from a planning perspective is that it's very important that you choose good managers and you choose good allocations. Next, we're going to talk a little bit about household income. I hear this often and on a regular basis. Well, I read somewhere that I only need 5%, 5 times my salary, or 4 times my salary, or 10 times my salary, whatever the number is. The good news is it doesn't matter what that multiple is, because I have a handy dandy pair of charts right here that tell us one thing, and it tells us one thing specifically. There is no set multiple relative to the amount of money that you make to the amount of money you should have when you retire that tells us whether or not you've got a large enough pool of money to live off of. That's the important takeaway here. And I can show you that, and I can demonstrate it straight away. Somebody who makes $30,000 to $40,000 a year at age 65 should have somewhere between 6.8, 7.2 times $30,000 to $40,000. Conversely, somebody who makes $90,000 a year should have 10.4 times. And if we go all the way out to some of those top earners in the DC area, the 250s and the 350s and 300s and above, we're talking about 15.3, 16 times their annual salaries. So what I can tell you is anybody who says, oh, well, I have $1 million, I'm good, it doesn't mean much of anything. Inflation, core, headline, Social Security, all of these things, everybody worries about inflation. And literally, if you turn on the news this day and age, especially with stuff that's been going on, I heard a thing about gas prices today and the price of milk, and yeah, I won't get into inelastic and elastic. So for those of you that are a little more academically minded, I'm sorry, but I'd like to, make sure I don't, have everyone asleep by the time the call ends. So that said, Social Security, Medicare prices, all those kinds of things, they're all based off of COLA. I know because we literally pulled it off the website. I have a PDF I can show you later if you really like. But the key thing is that we all have our own inflation rates. I have my inflation rates, Lauren has hers, everyone else has theirs, Shelby has theirs. Point is that this great little chart tells us what the average Americans spend their money on. What it tells us is it tells us disproportionately healthcare and housing. Okay, we've got core versus headline, we've got some of those kinds of things. Now we know that food and energy are excluded, core headline, and what it tells us here is it tells us that the amount of money we spend is likely going to increase an inflation rate greater than cost of living adjustments. Cost of living adjustments are based on inflation. So for inflation, when we're putting together financial plans, we're using a 4% figure. Now, I know you're probably thinking, well, William, inflation historically isn't 4%. And I would say, you're right. But we have had periods of time, 5 and 10-year periods, where inflation has been aggregate per individuals north of 3.5%, which comes really close to that 4%. And we've had a couple instances, for those of you that were alive in the 70s and early 80s, where we did have above 4% inflation. Now, not, during a 40-year period did we have it, but more importantly, the point is that we've got to insulate. We've got to stress test for those events. And that's what we're looking to do. That's what we're talking about today. And that's the important thing. So here's where we derive that 4% number. That same thing, I'm going to flip the switch a little bit. A number of you have said to me when we're going over these financial plans, William, I see that you're only growing my Social Security by 2% a year. How can that be? Social Security has to increase by a greater rate because it's adjusted with COLA. My answer, you're right. Absolutely. Point being, again, we're stress testing. So if I am looking for the highest probability of your Social Security growing at a specific rate, what I find is that the bulk of all outcomes, and this is, by the way, when I plug all of the information, and you can go, by the way, to Social Security Administration's website, ssa.gov/COLA, and you can actually pull what the COLA adjustments have been from 1975 forward. So yeah, the last 40 plus years to give you a pretty normal distribution. If you look at if you look at all of those, what you'll find is that it's right around 3 1/3%. So that's where your average is. You've got a little bit of standard deviation, the mean, that kind of thing. If you want to get really fancy with your calculus, what you'll find is that the bulk, about 75% of the outcomes, you will find that Social Security grows at a rate greater than 2%. And because we're stress testing, we're looking for 75, 80% of all outcomes, highest probability to occur. And so that's why we're using 2%. So 2% on basically income coming in growing, and 4%, so we're above COLA on the expenses. So money going out is going to go out faster and grow at a faster rate than we expect it to. And money that's coming in is going to grow at a slower rate than what we expect it to. And so that's going to, over a forecasting period, you got to realize, remember what I just said at the starting slide, age 65, 60, somewhere in there, folks are retiring, starting to draw off of their funds. And I'm carrying that out, forecasting all the way to age 100, 95. So I have a 30 plus year time horizon to worry about. So that's why we want to stress test, and we want a high probability of all of our various outcomes. That said, I mentioned the 60-40 model, 40-60 model, 60-40. I hear on occasion, William, you don't understand what my asset allocation. I read online that if the percentage of my bonds is equal to my age, I should be fine. Don't worry. Like, my asset allocation is good. Interest rates are good. The reality is that interest rates are more than just bonds in your portfolio. It's really about where interest rates are and where they're going. That's the big issue. And so where the interest rates are, where they're going, depends on what your housing prices are doing, what your food costs are doing. It factors into a lot of things. And so I pulled up this chart just to give everybody a really good idea about where we are with stress testing, trying to forecast returns for the future. So this first slide here on the left, what we're looking at here is we're looking at current yields in the fixed income market. Now remember, I said inflation was 4%. So when you look really closely here at these yields, there's not a whole lot of numbers above 4%. So what it tells us is that pretty much every single one of these bond holdings, and I shouldn't say every single one, but the bulk of them, realistically, their yield is basically just you guys losing money at a slow rate. Because what happens, cost of goods goes up, the cost of these bonds does not keep pace with it. And so we're in a situation where your income is not keeping pace with inflation. And so you're losing buying power. Therefore, you're losing money. These are a negative rate of return. Be mindful of those things. And this is what we try and forecast when we're stress testing. The other thing that we're doing is we switch over this other chart, the impact of 1% rise in interest rates. Could you imagine if you were living by that rule and saying, I'm going to have my percentage of bond allocations based on my age, and you were 75 and you had 75% of your money in bonds, and interest rates went up by 1% next year? Your portfolio would be negative. That's just a mathematical principle, and that would be kind of scary, and that's why you have good asset allocations. That's why you guys pay attention to that, and more importantly, that's why we forecast this inside of a financial plan, so we can model what those results would be. We can see what happens in the financial plan before it happens in the real world, so that way you all as investors, as planners, as folks that have the money, this is your life savings, you guys know what to do, you know what the outcomes are, you can protect against it, you can be prepared. And that is really the key reason that we do the stress testing. It's not to make people worried, it's because we want to have high probability of specific outcomes. And we want to have a high probability of a positive outcome when it comes to dealing with our retirement money. And so that's why we try and do a little bit of predictive modeling, saying, hey, well, what happens if interest rates rise? What happens if interest rates go down? Let's be prepared for those events. What happens if the market goes down by 10%? What does that look like? How does it affect your returns? How does it affect your spending habits? We model all those things. We try and forecast them, so that way when it happens, you don't worry at night and spend, your Saturday wondering what's going to happen. You know what's going to happen because you've already seen it. That brings us to this, diversification. We talked about rates of return in portfolios. I mentioned that 60-40 model. I mentioned some of those other things. And I mentioned that 5% number. Why that 5% number? What am I looking for in terms of stress testing? Well, one of the things that I'm looking for here is that if we look at very closely this particular allocation range, we get out here to a 20-year rolling period. So this is a 20-year segment of time that rolls forward. So this is about as close to a normalized distribution as we can get. What we see is that the range of outcomes, because remember, we're talking statistics here, so we're talking range of outcomes, sort of like line of best fit and upper and lower bound. If you think back to class, and I hope I haven't bored some of you to death already, but what we're looking at, this key number here is this 5% figure on this 50-50. So that tells us that if we do utilize a 5% rate of return, that it's conservative enough to where it's still better than inflation, but statistically what it tells us is that we should expect the bulk of the outcomes to be above that result. And that's really what we're looking for in terms of stress testing, is we're looking for the bulk of the outcomes to be better than what we're forecasting. And yes, I'm going to say that about 6 more times. So I've also heard this other wonderful kind of statement, which is, well, William, I've got Social Security, we've got these things, and certainly makes up a good portion of my income. That's guaranteed, it grows with inflation. Here's what it looks like. Well, this graph is really great. It's illustrative. I wanted to show it to you all because this is something that I see in practice as I stress test these returns, and as I process some of these plans, and as I look for action items. So what we find is that depending on how much you actually earn, and Social Security is in purple here, folks, depending on how much you earn during your earnings years and how much money you save will depend on how much Social Security actually makes up of your overall projected retirement income. And so we find that for those having lower income brackets in retirement, Social Security makes up a much higher component. And in DC, we've got a lot of folks with federal pensions, so we can add federal pensions to that. We're talking about CSRs, we're talking about FERS, we're talking about Social Security. That's this kind of guaranteed income column. We find that that makes up a large portion. And that's key, by the way, because we know that money's going to be there. It doesn't move with the market. It doesn't have the ability to keep you up on Saturday night. Well, maybe. This particular slide is also really interesting because some of the things that we talk about the fact that in my office, we talk about this concept of a second chapter in our lives. Frankly, remember, if I retire at 65 and start collecting Social Security, if I live to age 100, that's 35 years. That's practically a third of my life. I'm certainly not going to sit in a rocking chair. I'm going to keep myself busy. Maybe I'm going to go to the Kennedy Center and be a docent, catch a play. And maybe I'm going, because I really love art, maybe you will find me at the Smithsonian working as a docent, doing something along those lines. Who knows? But when it's time to retire, when I'm no longer able to do this, and it's time to hang it up, then I may stay in the workforce, and that is realistically, that's what we're finding here with this chart, and this chart really illustrates that simple fact. So it's okay to work longer. It's okay to stay in the workforce longer. I say that. I actually have some clients that are in their upper 70s, that are in their early 80s, that are still part of the workforce, that are still collecting a salary, doing various other things. They're probably not working at the same, as a matter of fact, I know they're not working at the same pace that they were in their 50s and 40s, but they are still working, they are still collecting a paycheck, they are still part of the workforce and listing themselves as gainfully employed. And so that factor also comes into play here when we're stress testing financial plans, because if your plan is to stay in the workforce for a very long time, we need, and that, we basically are able to use that as a mechanism to say, hey, we don't have to save as much money today because we're going to work longer. One of the things that we need to model out, one of the things that we need to prepare for is what happens when you're older if your body betrays you and you're not able to work into your mid-70s or 75 plus. That's a pretty big deal. And we see, by the way, in the last 20 years, we see almost a 50% jump from 8% to 12% in that category. So that's a big part of time, present value, current value, the things that we look at and the things that we incorporate into stress testing a financial plan. Now, I have glossed over a couple of things. I mentioned, I didn't talk a lot about personal expenses and spending. I didn't talk a lot about personal savings rates, but I did mention it briefly here. And some of these particular statistics we can infer from my statements. I talked about being in the workforce here longer. Well, that can directly affect your personal savings rate. You don't have to save as much money if you intend to work a really long time and have a much shorter period of time when you're drawing off of your assets for income. You can also enhance your Social Security benefit. After you reach full retirement age, your Social Security benefit grows by about 8% a year while you're deferring until you're age 70 when you're actually forced to take it. The other side of the coin, personal expenses and spending. I mentioned, and I spent a lot of time on interest rates right before that. Well, one of people's largest purchases they ever make in their entire lifetime is very simply their home. Well, if you're buying a home and you're paying 2 and 3 and 4% on a, and dare I say 4% in this day and age, on a 30-year mortgage, that is really low interest. That is really cheap money. You are going to have money to spend in other areas, because when I bought my house initially, my mortgage was north of 6%, and I know some folks that when they bought their first house, mortgages were, on a 30-year fixed, we're talking north of 6.5, north of 7. And so, the idea of 2 and 3% on a 30-year fixed mortgage, very cheap money, and it allows you to manage your personal expenses. And that's going to play into, by the way, how quickly you pay off the house. Traditional thinking for planning originally said, pay off your house before you reach age 65, pay it off as quick as you can. If it's a 6-7% interest rate, absolutely you're going to do that. So that's what I have for you all as far as how we stress test these plans, how we start to build them out, what we're looking for. And like I said, it boils down to one thing. We're looking for conservative values inside of these standard variables. So we, as in someone who does financial planning, can manage the variables, work with the information given to yield a highly probable result that we're going to have a positive forecast. And a positive forecast means, is it attainable? Is it achievable? Are there few events that can derail the plan, such as a major market movement, a super cycle, rising interest rates, all those things? We want to really make it as bulletproof as we can, so that way folks that are actually in retirement and folks that are spending the money, living off of their assets, can sleep well. That, I'm opening the floor up to questions if we have any. Switch my gallery view so that I can see things. And I'm going to check the mail. One moment, please. Looks like you do have a question loading. All right, I did get one question. So on the Social Security side, if you all are looking for where I got my numbers regarding Social Security, if you go to ssa.gov, you can search for COLA, C-O-L-A, on the website, and it will actually give you all of that information. I can share the screen with you, what it looks like real quick. It's time. Here's a copy of that page. I'll show you here's the website for everybody, ssa.gov/COLA. And then what you'll find is from 1975 forward all the way to 2021, because we projected 2021 what the COLA increases are. Got anybody else? All right. Doesn't look like we have any more questions. So if you've got questions and you're on the call, or you're watching the YouTube video later, please reach out to us. If you've got questions, we'll try and get them answered, model them into your financial plan, whichever you like. Always happy to answer these questions. And for everybody that joined in this evening, thank you very much for your time. Greatly appreciate it, and greatly appreciate y'all tuning in while I talk about something I'm really passionate about, which is the numbers and statistics. So that said, until next month or until I see you again, have a great evening, and we will talk again soon. All right, bye-bye.